Hi, I'm Danielle Poli, head of the Product Specialist Group at Oaktree. I'm here with Armen and Panossian, head of Performing Credit, to discuss key market trends and elaborate on some of the themes that we've included in our recent Insights piece. So, Armen, where do we begin?
I think we begin from the beginning of last year, in 2020. I think a lot of the performing credit liquid strategies, high-yield bonds, senior loans, convertibles, structured credit, were all priced in a way that was very healthy, reflective of pretty strong fundamentals in the economy and the underlying borrowers, as well as stable technicals. In March, we started seeing, or in February, we started seeing the first cases in the US, and the speed of the pandemic was, I think, quite alarming. By March, we saw meaningful outflows out of these once stable credit markets. Very healthy credits that, in fact, were stable or even positively correlated with the coronavirus, saw their securities trade down 10, 15, 20 points. It felt a lot like 2008, 2009, and part of 2010 to me. But pretty much since then, it's been a straight line up. And I think, for me, that's been a very telling lesson learned about the resilience of not only the US economy, but of monetary policy in the US. What we saw in the global financial crisis, we were kind of developing tools as we went. There was Fed and US Treasury intervention that some of it worked, some of it didn't work back then. We learned a lot from that experience. And that toolkit was really brought to bear very quickly in March and April. Bazookas of fiscal and monetary stimulus came in and really helped to put a floor beneath the US markets and gradually helped to lift it out.
And this incredible amount of government stimulus that we've seen, as you step back and think about the effects of that, what stands out to you?
Well, it's a variety of concerns and considerations. First of all, as an investor, it just means that periods of volatility are getting shorter and shorter. So you have to be willing to be bold, decisive, and take advantage of opportunities to deploy when liquidity is in your favor. If you asked me on March 20th, how much capital could we deploy in a discounted opportunity, I would have said it's incalculable. It would be billions and billions of dollars, and it would last for a long time. The reason for that was because so many industries were impacted by the coronavirus, so many large businesses that employ millions of people globally continue to be impacted by the coronavirus. And I would have thought that the distressed opportunity would have lasted many quarters, if not years. I still think that in some segments of the economy, it will last years. But broad-based, the very healthy parts of the market were able to recover much faster because of the fiscal and monetary stimulus. What it also has told me is that we will have a longer-term issue on our hands, potentially, because of the liquidity that's been injected into the markets. At some point, the fiscal stimulus and the deficit spending that we've done will cause some impact to the economy, either in the form of higher taxes or in the form of ballooning federal debt that will be costly to service. For now, rates remain low, but it might not continue to be the case over the medium term or long term.
And in fact, maybe staying on rates, while the lower for longer was definitely the prevailing narrative towards the end of the year, here we are with rates rising at the beginning of 2021. What are your thoughts?
Yeah, I mean, rates, it's a fascinating topic because the swift movement of rates, either tighter or wider, can often overwhelm any sort of short-term credit problems, and they can influence the trading prices of securities irrespective of the fundamental issues or benefits that may be present in those businesses. The significant investment grade and high yield bond issuance that we saw in 2020, that extended out the duration of those two asset classes. Even though the companies that were able to issue debt in 2020 were probably the best of the issuers in the IG and in the high yield space, now that their duration is longer, if rates do rise, we will see an impact on the trading values of those securities. You're right that lower for longer was the mantra in most of 2020 because everybody felt that rates must stay low so that the US government can sustain its debt load. And I think that the Fed will continue with lower for longer, even if a little bit of inflation starts creeping into the economy.
Do you think that this is a reason for some of the recent appetite for U.S. loan funds? December saw the first monthly inflow, I think, in 26 months. Is that investors looking to manage duration in their portfolio? What do you think is causing that?
Yeah, I think, yes, it is for sure investors managing duration. They are moderately exiting high yield bond funds and entering senior loans, both of which are below investment grade. And it is because loans have very low duration. It's also, and it's a related point, their loans have a floating rate feature to them, typically LIBOR plus a spread. And if the conventional wisdom is that rates generally will rise, that means LIBOR should also rise. They don't necessarily have to move in tandem. LIBOR on the one hand and the 10-year Treasury, for example, on the other hand, they don't need to move lockstep with one another, but they are related to one another. If an investor believes that rates will rise, the way to take advantage of that upward movement is to have a floating rate security. And senior loans, CLO tranches are really two very large markets that do have the benefit of floating rate features to them, low duration, and in the case of CLOs, some meaningful call protection.
And CLOs, I mean, in addition to their call protection and other attractive features, they have seen a very strong recovery, and they did in the fourth quarter. But they still offer a yield premium compared to other similarly rated asset classes.
Absolutely. For rating-sensitive investors, CLOs are a very attractive way to get excess return for similarly rated instruments. For example, a BB rated CLO tranche today will yield around LIBOR plus 575 to 685, and that's for a pretty high quality portfolio underpinning the value of that BB tranche. BB rated high yield bonds, on the other hand, are around 3 to 3.5%. So you're really getting a nice 300 or 400 basis point pickup and moving to a portfolio that is diverse. In the case of a high yield bond, yes, they're high quality if they're a BB, but it's a single issuer. Whereas in the CLO context, you could have 70 to 250 names, issuers, inside of a CLO, which that diversification really gives you some additional collateral benefits if the economy were to kind of go through another rough patch.
And another way that we achieve floating rate exposure in our portfolios at Oaktree is with real estate-backed securities. Those had a tough period during the dislocation, but have made some good progress. Any thoughts on that asset class?
Sure. Real estate is an area that we have great conviction on at Oaktree. Obviously, some portion of the real estate industry is still under examination around what impact coronavirus will have. And as a result, there is a sort of a credit picker's opportunity here within the real estate debt securities landscape. If you take a constructive view on recovery, there are hotel bonds, hotel loans, hotel CMBS that you could buy to express that view. Same could be said of retail and of office.
I'd love to stay on the theme of being a credit picker. We have an emerging market debt business that is not as broadly diversified as the indices, which have seen significant spread tightening and really no longer offer attractive value relative to US or European high yield. What are the spots that we want to be in EM today? And tell me a little bit about your views there.
Sure. Yeah, you bring up a great point. EM has had a massive rally coming out of the coronavirus pandemic. Today, broad-based EM, so if you were to look at the emerging markets index, it really doesn't offer, from my perspective, an appropriate risk-adjusted return relative to developed market high yield. However, as you point out, there are specific industries, specific geographies that do offer very attractive risk-adjusted returns and stories around a recovery. We are very actively engaged in Argentina, a variety of different industries in Argentina. We are focused on hard currency denominated debt in the emerging markets, and so not looking to take local currency risk or translation risk around FX. And we are very much focused on companies that are able to generate the cash flow needed to deleverage themselves without any third-party intervention, whether it be the government, the IMF, World Bank, or what have you. So we're really excited about parts of the emerging markets, but we're not a buyer of emerging markets on an index-oriented basis broadly.
And another strategy at Oaktree where that would apply would be our global convertibles business. And certainly equity markets have lifted up convertibles, but the way we employ them is opportunistic. Maybe some thoughts on that too?
Sure. We have a global convertibles business that has three different areas that it focuses on. The first is busted convertibles, those convertibles that trade and behave more like high yield bonds do, rather than having a significant amount of equity-related volatility either to the upside or to the downside. We call that kind of trading at their bond floor. The second is U.S. convertibles, and in the U.S., the convertible product offers very nice diversification to a multi-strategy type of credit vehicle. Over 50% of issuers in the converts market are life sciences, healthcare, or technology-oriented companies. You really don't see much of those industries in high-yield bonds or in senior loans. You do see some healthcare services in those areas, but you typically don't see biotechnology. You typically don't see IT or software. And so having that diversification and to have the potential upside associated with the equity performance of those industries has been a nice diversifier for us, an area that we've been able to generate alpha in 2020. And we have a pretty meaningful allocation there in our multi-strategy credit offerings.
Right, so we've talked a lot about where we've been. Where are we going now? How should investors position?
Yeah, it's a little bit like Groundhog's Day. I think we're back to January and February of 2020 in some respects. And what I mean by that is that a lot of the liquid performing credit securities are back to pre-COVID tights. Obviously, those industries that are most deeply impacted by the coronavirus remain discounted. But by and large, the healthiest 90 or 95% of issuers in the broadly syndicated loan and high yield markets globally are back to their pre-COVID tights. The trading prices of these securities are at their call prices, which means that from a trading price perspective, there really isn't much room for them to run. You could continue to earn your coupon. The coupons are attractive. The income is attractive. The opportunity set is diverse. So we are able to put together very attractive portfolios that are cushioned or are built in a way to anticipate a potential drag down because of coronavirus or another shock to the economy. We think structured credit provides attractive risk-adjusted returns to get some incremental spread with what we think is an appropriate level of risk, and are finding ways to merge what we're doing on the liquid credit side with what we do on the illiquid credit side by offering solutions that bring to bear both types of transactions. So we're really excited about that next evolution of what we do in multi-strategy credit at Oaktree, bringing together those types of strategies and leveraging other groups at Oaktree to provide a product to our investors that we think is very attractive.
Well said, and I think that that's a great place to stop. Any final thoughts for our viewers?
Stay safe, stay healthy, and hopefully we'll all be back in the office soon.
Well, thank you all for joining us for Oaktree's Performing Credit Insights. Armen, it's been fun. Thank you.
Thank you.
And we'll see you soon.